Hello everybody, welcome to this MGAA BLM briefing. I'm very delighted that Terry Renouf and Alistair Kinley are joining us today. I should say we're not expecting any fire alarms, so if there is one, can you please leave through that door and up the escalators. And also if you could turn your mobile phones on silent or off, that would be very helpful. So Terry is a consultant with BLM. Right, I'm going to leave Terry to introduce himself. Okay, over to you. Who's starting?
Yes, I'm not actually starting, but I'm Terry. You've got the stuff in the information pack. My colleague Alistair and I are going to speak to you about 4 topics. Alistair's going to kick off with discount rate. Apparently it's important. I'm then going to look at some issues arising from a report from Lord Justice Jackson. Then, to make it a bit more interesting for you, we're going to just alternate, and Alistair will cover some Whiplash reforms and some proposals which are either in or shortly to go through Parliament. And then I'm just going to wind up at the end with a little summary of some work we've been doing on fraud issues. So,
thanks, Jane. Thanks, Terry. Afternoon, everyone. I'm going to try and cover off the points 1 and 3, discount rate and Whiplash, and you'll hear from Terry on Jackson, as he mentioned, in between. The debate on the discount rate has been going on for quite some time, and the movement of the rate in March from 2.5 to minus 0.75 is the first time it was changed in 16 years. It was set in 2001 by Lord Irvine at 2.5% based on, as you probably know, the yield on index-linked government stock. And that's where we are at the moment, but there are proposals to move that. And I'll take you through the recent history and what some of the future might look like under those new proposals. So this was the news that we got on the 7th of September from the Ministry of Justice. I'm not expecting you to be able to read that text, and I'm not going to read it either, but this was the announcement of what the government intends to do after having consulted on a new way of setting the discount rate, on a way of breaking the link between the rate and the yield on index-linked government stock. And that's really important because clearly the discount rate as an indicator of investment returns that claimants can generate on their personal injury awards is going to drive the calculation and the ultimate amount of the award, because the bigger the discount, the less you need to be given at the outset of the given period in order to provide that net present value calculation. And the lower the rate of discount, and even into negative, you need to give people a lot more cash at the outset, because their assumed investment isn't performing as well, and indeed in the world of negative rates, they're assumed to be investing to lose money year on year, which seems to be a really ridiculous assumption. And I don't think any IFAs would advise claimants to do that. And that's probably why we're going to be moving away from that express link between index-linked government stock and the discount rate itself. But the Lord Chancellor said, that doesn't really work. We want to move away from it, and we're going to have to legislate, because the discount rate's a statutory piece of law under the 1996 Act, and there's some case law that bolsters the link, that's Wells and Wells, and it bolsters the link between the rate at the moment and index-linked government stock. So he says we'll need a new piece of legislation, it's mentioned up there, and when we get through this process, we think the rate's going to be, you see it in sort of 2/3 of the way down, in the range of 0 to 1% for future cases. So how are we going to get there and where we come from? Well, that's just a recap of where the powers to set the rate lie in the 1996 Act, and I mentioned the case already, and it's linked to gilts, but those yields have deteriorated. So the Lord Chancellor at the moment has had to stick with them until such times as we get a new piece of legislation that expressly breaks that link. And the announcement of the legislation, at least, was heralded on the 7th of September, and some draft provisions were published then as well. I don't want to talk about the detail. It's relatively straightforward, that legislation, and really it just resets the assumptions around investment returns. So this is why we've had to move from 2.5 to minus 0.75. In 2001, when the last statutory rate was set, the yields on index-linked gilts were between 2 and 3%, running around about 2.5%, as you can see. So that seemed to be a pretty sensible basis on which to set a discount rate for claims for future loss. And the recommendation to do that had come from Law Commission work way back in the late 90s on the other side of the slide there. And they said, because you get protection against inflation by the use of index-linked government stock, that's in the name, isn't it? Index-linked government stock. That's a sensible thing to base investment assumptions for personal injury claimants on. And it probably was at the time. It definitely was at the time, and there was really no controversy then. And the rate went to 2.5%, and that was that. But as you'll see, the rate has deteriorated significantly over the period 16 years since. And no surprises, it took a bit of a bump in sort of 07, 08, 09 through the financial crash. And it's gone down since. Factors such as QE and the regulatory requirements of insurers have really driven this to a low rate. And, as I said earlier, a rate at which, for me, makes it unrealistic to assume that people are going to invest in that sort of asset when it's returning below the line. It really doesn't appear to make sense at all. So the government said, what do you think? We want to change it. What are your views? So they are going to legislate to change the way the rate's set. And as I said earlier, the expectation is the rate will land somewhere between 0 and 1%. So a big improvement on where we are, but obviously not back to the 2.5% level. What does that look like in terms of the claims impact? Well, this chart's a little bit busy, unfortunately, but I'll just take a little bit of time to explain where we are on that. Taking male claimants, 10, 30 and 50, so you've got a kid, somebody working age, and somebody in the middle of their career, and just looking there at the data and the chart, what's the effect of these different discount rates? And the key to this is really that the horizontal axis there is 0%. That's not 0% discount rate. That's no change on 2.5%. So these lines show the change in multipliers based on what we had before, the 2.5% rate. And you can see the red line is the minus 0.75 rate. So for the 10-year-old, you can see that the increase in the lifetime multiplier, 10-year-old kid gets badly injured, needs lifetime care, you're going to have to pay 3 times more because it's a 200% increase. And for the 30-year-old, 2.5 times more, 141% increase. And for the 50-year-old, it nearly doubles, an 83% increase. But if you rerun that analysis and then look at the 0 to 1% band that I indicated, that's between the two blue lines, and you can see the range of increases there compared to the 2.5% rate, which applied up until March. Now, they are still significant increases, obviously higher at the lower age because of the longer term of the loss, but nowhere near as dramatic. And the rate is likely to land somewhere in between those two blue lines, and that gives you an indication of the levels of increase in awards compared with the situation pre-March. So, really just from some charts to some examples. And we put this together, really, this is a theoretical case study, as you can see, just to show the gearing effect of the increase and where it actually lies. And this is 5 million excess, 5 million policy. And you can see in the claim that we've put together, it's increased from 6 to 7.75, and all of that increase falls into the higher layer. Nearly doubles the higher layer's liability, whereas the overall increase in the claim value itself is less than a third. So that's quite a serious difference and something that's worth bearing in mind. And in fact, it may produce factors that are outlined along the bottom there in sort of worst case scenario. Reinsurance protection prices could well rise, all other things being equal. Could possibly be a reduction in the market capacity because of this further demand on capital. But those are just sort of factors to bear in mind rather than definite predictions as to what could or might happen. And a couple of real-life case studies. And these are cases that we've had in the firm that show, I think, the effect of the change, and in particular, what can happen with regard to policy limits. We've got the first one there, 23-year-old claimant, 10 million policy limit, and the value of that claim, fairly young individual, as you see, has gone up to 20 million against a policy limit of 10. Where's that extra money going to come from? I suspect nowhere. I suspect that business might fold as a consequence. And, you know, it's a bit trite to say that's not a good outcome for anybody, but it isn't. Not for the business, not for the claimant, not for anybody involved in that. And indeed, at one level, for the reputation of the industry, if we're not protecting our clients with the right level of cover to match the liabilities that they face. And you see the same in the bottom example. Higher age claimant increases slightly less dramatic as a result, with slightly less term, if you like, because of that. But clearly here, you've got a low PL policy limit of 2 million, which may not be that common in the commercial space, but certainly in domestic business, household and SME stuff, it's not uncommon. So again, there's some dramatic effects possibly there as a consequence. So what about those limits and what should we do about them? I apologise for the shopping trolley. I asked our publications team if they could produce something that illustrated the market. I'm afraid that's what they came up with. Well, there we are. At least it's not a meerkat. So those are just some questions to think about. And maybe it's best just to leave that for a moment and let you think through it. And when we get to the end of the session or afterwards, perhaps, we could talk through some of those. But I think, you know, for me, the headline is claims over 10 million are really not uncommon now, far from it. However, we still have a statutory EL minimum of 5 million. How does that work? Is that really fair? Is it appropriate at the moment? I don't know. I know lots of the market provides 10, but even that might not be enough if we go back to the examples we have here. So, will limits be increased? Is there a kind of top-up market? Probably in EL, not so much in PL, I don't think. Will claimants go uncompensated? That's reasonably likely if the insured has no other assets. And will they pursue greater numbers of defendants? I think that's quite likely. If you've got my example earlier on, 7.75 million claim, with potentially 2 defendants in that, and one only has 5 million a cover, you might go against, not the employer, but the occupier, to try and secure a little bit of the missing 2.75 top slice. And that settlement might have some nuisance value as against one of the other defendants. So maybe we'll see more defendants being brought in, much like US litigation, where you sort of tot up the various policy limits to get to the sum that the plaintiffs are looking for. We might see some of that here in certain circumstances because of the effect of policy limits. So I think that's really where we are. I'm sorry to take a fair bit of time on that, but it's still taken very much a summary level and a little bit of a rush. When's it going to happen? I have absolutely no idea and couldn't say with confidence at all. Maybe end of 18, maybe early 19. My feel, and it's no more than that, is that I think the government should be put under pressure by the industry not to allow the minus 0.75 rate to apply over 2 1/1 renewals. So 1/1/18, okay, it is what it is. 1/1/19, I think that's probably really quite awkward commercially and for customers. I think the industry should lean on government to say, come on, pull your finger out and push this legislation through. So we don't have 2 very awkward renewal periods under this low rate. But that said, it needs legislation. That's always uncertain. We've got a minority government, lots of uncertainty around that, and the legislative timetable is going to be taken up by Brexit as we get towards the date on which we leave. That creates some further uncertainty, so I really don't know when it's going to happen, but the government say they want to go quickly, so perhaps this time next year we might have something concrete to talk about and the prospect of an actual change date. And just on the change date, worth bearing in mind that whether it's prospective or retrospective probably depends on how you define those terms. Not going to go into that, but when the change is made, it will apply to any case settled after the new rate comes in. So that might be prospective because it's cases settled afterwards. You might regard it as retrospective because cases settled afterwards, but that relate to policies that were issued before, that they're going to respond as well. So maybe a question of taste, but I think the trigger date is anything settled after maybe October, if it's October 18, or March, April, if it's March, April 19. Devolution aspects, very much a footnote. The change I'm talking about is expressly for England and Wales. Scotland has said they want to do their own thing on this, but they might well follow the 2.5% rate. Northern Ireland, they might well follow what England and Wales does. Northern Ireland, in theory at least, still has the 2.5% discount rate because they find themselves in the difficulty of not having an administration to have made the change to minus 0.75. But one would have thought that perhaps the prospects of going before a judge and trying to argue 2.5 when the claimant says it's minus 0.75 in the rest of the UK, you'd have thought that the prospects of that argument succeeding are fairly remote. But there we are. And really the summary of that is there will be a positive change to the rate, which will improve reserves, claims estimates, and ultimate outcomes as well, if the legislation passes. And deliberately underline the if, because there is a lot of uncertainty around it, as I said. So that's me on the discount rate. I'm going to hand you back to Terry on Jackson.
Thank you. The discount rate has created an awful lot of noise and discussion and conversation. And one of the other events that occurred during the summer was a publication of this report by Lord Justice Jackson. And I need to wind back a little to 2013, which was when LASPO reforms came in, MOJ, Jackson and all of that. I think it was broadly collectively known as the Jackson reforms, but actually it was a fairly complicated series of reforms that came in partly through Parliament, partly through amendments of statutory instruments and so on and so forth. And this is the slide that I'm surprised hasn't worn out, because Alistair and I used it so often around about 2012, 2013. And the quote, actually, you'll see, goes back to his, I think that was either his interim or, no, actually it was his final report in December of 2009. So you can see 2013, it took 4 years to implement quite a complicated piece of reform to the civil litigation process. And he said at that time, in some areas of civil litigation, costs are disproportionate, legal costs are disproportionate, and impede access to justice. Proposes a coherent package of interlocking reforms designed to control costs and promote access to justice. Well, it was a coherent package of interlocutory reforms. There were one or two little bits and pieces that went by the wayside during the implementation phases. But if you cast your mind back, the era prior to reform was when success fees were recoverable. So it was not just the base costs that were paid, it was the success fees were being recovered by the claimant's lawyers. The after-the-event premiums were being recovered. And so there was a lot of reform that needed to take place. And I say it's a balanced, coherent package of interlocking reforms. So we've moved on, and we are now, 4 years since the reforms were implemented. And the judiciary asked Lord Justice Jackson to go back and look at one aspect of his reforms around fixed recoverable costs. Now, there is, of course, a sense that he's being asked to mark his own homework, but that report did say, yes, I've looked at it. I looked at the whole issue of costs, and he concludes that the recommendations that he made and that were implemented were broadly successful. And he is now proposed in July some further reforms to legal costs, and they are actually they're actually very extensive, and I believe they're going to be very significant. So say the 2012-2013 reforms covered pretty much personal injury. So we had an uplift of general damages, remember, of 10% for the cases where success fees were no longer recoverable, after event premiums were banned. And that is a significant part of the civil litigation market. But everything else was pretty much left out. And what Jackson now says is that his fixed recoverable costs, which were fast track, personal injury, are now going to be broadened and will include all fast track claims. Few exceptions granted, but will include all fast track claims. So, for your personal injury claims, we are 1,000 to 25,000 damages. The 1,000 is subject to further reform, which Alistair will be looking at. But 1 to 25,000 personal injury damages subject to a fixed recoverable cost regime. You've got cost certainty. You know how much is going to have to be paid. Actually, right, he now says, well, this is working for personal injury. It's a big sector of civil litigation. Now, all claims that are fast track subject to fixed recoverable costs. And part of his remit for that report was to look and see whether you could broaden that. Actually, he looked at where the claims up to 250,000 of damages, so very significant damages there on many, many cases that will be running through the courts. 250,000. He actually concluded that was a bit too difficult, but he is proposing an intermediate track for the 25,000 from the edge of the fast track up to 100,000. So, his proposals are pretty much that every civil litigation claim, all damages, where the award is up to 100,000, will be subject to a fixed recoverable cost regime. Now, you'll find on your... all I've put this up is because these are on the packs on your seat, so you've got all of the detail that you've needed. So I think this is a 144-page report summarised into four tables, which Alistair has prepared. But I thought it might be helpful just to just illustrate the how straightforward costs become. This is the fixed recoverable cost calculator that sits somewhere on the BLM website. Now, I've tried to create a link so we could have a live demonstration with people calling out from the audience what the damages should be, but happily, I assumed that the technology wouldn't work. So we have an award here, £19,397 of damages. You type that in, or you sort of scroll it around on the little dial at the top. You decide at which stage, because the case settles at certain stages, and there's only 4 or 5 of those. You click on that. What type of accident is it? Is it employer's liability, public liability, or RTA? What's the date of the accident? Because depending on the date of the accident might affect the costs payable. Is it a London firm, which actually means is it a London claim being run by a London firm? And you get your costs figure. Claimants recoverable legal costs in that instance, £12,317.64. No argument about it. Done, dusted. That would probably take you 10 or 15 seconds. And that is the regime that Lord Justice Jackson is proposing. He thinks and believes it's attractive to the consumer. Costs become predictable. Costs become recoverable. And you're not waiting months and months, papers going off to a cost draftsman with the argy-bargy and further costs being incurred afterwards. So we are working on a fixed recoverable 2.0 calculator, anticipating when the reforms come in. And it will be very similar to that. Certainly in the fast track, pretty much some of the underlying figures change a little bit. For instance, he allows 4% inflation, which is not bad since 2013 when this first came in. And the change, instead of accident type, you're going to have bands. So it's going to be band 1, band 2, band 3, band 4. And that will be either agreed between the parties in pre-action correspondence, or will be, if you can't agree it, and it is issued, it will be determined by a judge at an interlocutory stage. But you will have that predictability. The only unpredictability is quite how much damages might be payable. And that 19,000 figure will go up to 100,000. So as I say, sort of a significant change to the process of assessing costs. And I think the important thing to consider is the sort of the other issues that will follow on from that. So as I say, sort of the extension to from in the fast track, fixed recoverable cost now goes from beyond injury to all claims. Band 1 is simple debt recovery, and you'll have a fourth band which is complex, which could include In the fast track, it's still going to be a one-day trial, probably written evidence from experts. So, it's a pretty straightforward trial. It excludes clinical negligence because it's difficult, complicated and horrible. And Lord Justice Jackson has encouraged Department of Health and the various organisations to get together to try to sort out something for clinical negligence. NIHL deafness claims excluded because there's already an agreement that has been negotiated. And abuse and mesothelioma as well is excluded as well. But broadly, pretty much everything that is presently going through will fit into this fast track. And as I've mentioned, a new intermediate track is proposed for damages up to 100,000. And we're sort of colloquially calling this Jackson 2.0. Some of the issues, well, claim spikes. We saw, you all saw, when fixed recoverable costs were first introduced, let's say the conservatism of the legal profession preferred the old way of doing things, happened to be probably more generous, but nevertheless there was a huge spike in activity prior to implementation of the reforms, and that will happen again. Will there be claims inflation? At that threshold of, sort of the £80,000 case, there's probably will they try and push it up beyond the 100,000 to avoid the intermediate track, to avoid those fixed recoverable costs? Might we be looking at forum shopping as one of the other issues that we're thinking about? I think within personal injury, your choice is either to litigate or not litigate, but actually in some of the other jurisdictions, some of the other areas of where we're looking at, will arbitration become relatively more attractive? Will adjudication in construction disputes become relatively more attractive? Will people be looking at their contractual remedies as well, rather than going down a fixed recoverable cost environment? And the big question, what is going to be the behavioural change? If legal costs, now I think one of the, even in a ban in intermediate track, complex case, up to 100,000 damages, you might be looking at recoverable legal costs of £60,000 of that order. Now, you're looking at some of the professional indemnity cases that you deal with 2 or 3 experts, sort of an actually £60,000 for the lawyers to prepare and deal with that case is, I think they will probably say, challenging. They're going to have to deal with matters differently. How will they deal with matters differently? And the positive is, of course, that you will have cost certainty. And I wonder whether cost certainty may mean that the third-party funders, after the event insurers, will again look at the market and be providing solutions and options. Timing. Jackson reported 31st July. He is absolutely brilliant. If he says he'll do something by a certain date, he does it by that date. It is now in the hands of judiciary for them to consult, because it was a report to judiciary, and the government are also looking for a consultation. It wouldn't be hard to implement. It is relatively straightforward. It's an extension of existing schemes. So in many respects, it's not like the 2012-13 reforms. You don't need legislation. It is relatively straightforward. It could happen fairly quickly. The noise seems to be, I was sort of reading Law Society Gazette again this morning, avid reader, but we sort of thought, well, actually, this could happen quite quickly. Could be next year. The government is being asked to look at LASPO, do a review, could easily say, conclude, as Jackson did, that this is working well, let's extend it. It could be 2018, but actually the noise, the tip-off seems to be it's not going to happen that quickly. So we need a government consultation. As Alistair says, they are getting busy. Brexit is on everybody's table and desk and taking up a lot of time of the government. But it doesn't need legislation. So it could go through. And that, I think, is all I can cover, and we're bang on time. So Alistair's going to quickly cover some whiplash and small claims, some of the other issues that are arising.
Yeah. This is probably this section will be a lot shorter. The robotic head there is meant to be a terminator. And the reason why I picked that is because these proposals around whiplash and small claims reforms, and I deliberately take them together because this is not just about motor. It's also about PL and EL and any personal injury generally in any class of business. It's not just about motor. So I've taken them together really just to emphasise that. But the first bullet point there, these reforms go back to George Osborne's autumn statement in 2015. You'll remember, how could you forget, that 7 months after that we had the referendum and we decided to leave, and the Cameron-Osborne administration disappeared. Mrs May came in. About another 7 months after that, she had another vote, and there was some shake-up after that as well. And these proposals had been pushing forward, and despite the change at the referendum and despite the change at the election, these are still on the government's agenda. And a few days after the election, in the Queen's speech, this is from the background material issued with the Queen's speech, to talks of the Civil Liability Bill, which will ban pre-medical offers and introduce a tariff for whiplash claims. Fine. No mention of other types of case there. But the related reforms, and this sort of speaks to what Terry was talking about, the related reforms to change the small claims limit, the point at which you begin to recover legal costs in a personal injury action, that's going to change by a statutory instrument, by secondary legislation. It doesn't need primary legislation, which is why it wouldn't be mentioned in the bill. But that is running alongside, and the government has always said, we will change the small claims limit when we've finished the whiplash reform process. And the proposals there are to double it in road traffic cases to 2,000. At the moment it's 1,000, and that hasn't changed since the early 90s. So it's really time that that was increased significantly. Sorry, change it to 5,000 in RTA and 2,000 in casualty. I've got those the wrong way around. I'm surprised that got through quality control, but apologies for that. We'll revise these perhaps before they get posted and circulated. So it will reflect all types of lower value personal injury claim, and very much away from the high end cases that I was talking about in the early part of this session. So really two key elements here for whiplash in the main: a ban on pre-medical offers. There's a real concern in government that insurers settling cases, road traffic cases, without medical evidence is a real encouragement for fraudulent cases to be presented. And you have to say, standing back maybe from one's day job, feels like there's something in that, doesn't it? You know, so I was hurt in road traffic. Oh, okay, fine. I had paracetamol for a few weeks. That's fine. We'll make you an offer. Doesn't feel like the most rigorous forensic process. And the government's suggesting that there should be a ban on that, and that medical evidence should be obtained from Medco-registered doctors in conjunction with the MOJ portal process. So we'll see when that happens. There was a piece of legislation that attempted to do this before the election, the Prison and Courts Bill, and it made some progress through Parliament, but it wasn't sufficient priority to get fast-tracked to implementation before the election, and it fell away. So the new legislation, whenever it's published, the Civil Liability Bill, has to go back to square one and start again. But our best guess is that the provisions on whiplash will be very, very similar, if not identical, to what we saw earlier in the year in the Prison and Courts Bill. As I say, it needs some secondary legislation as well, and it will increase the small claims limit. So some challenges there, and I'll touch on those in a moment. But just to give you an idea of the government's ambition here and what it wants to do by way of tackling what it perceives as abuses in the low-value motor space, is the tariff taken from the Prison and Courts Bill was here on this side of the chart. And you can see that the amounts for whiplash claims up to 2 years duration of symptoms are significantly cut if this tariff goes through. And I think what the government has in mind, that will not only discourage people from making claims in the first instance, it might not actually provide sufficient by which claimants can share some of that with their lawyers, because most lawyers do these cases on a conditional fee agreement and can take up to 25% of damages by way of success fee from their client. And Terry reminded us that success fees from you guys, the ending of that recoverability was part of Jackson's first proposals. So is there enough money in the tank for these claims to come forward? Could you be bothered for 225 quid? Could you be bothered for 3725 when you might be getting 66 at the moment? Those are all questions which the government thinks will push down the incentive on claims coming through. I'm not so optimistic because I think through the reform process, through Jackson and through the portalisation of claims, numbers have been pretty static. They've bumped around a bit between sort of 750 and 800,000 RTA claims a year. And they haven't really dropped that much. So who knows if we'll see that here. We might do. But we'll see a reduction in the costs in any event because of these cases going into the small claims track, RTA cases under £5,000. So just a reminder there that these claims will go through the MOJ portal. Certainly the road traffic ones will, as will the casualty ELPL cases. And at the moment, the difficulty, I think, structurally with the claims portal is that it's not designed for consumers to use themselves. And if the claims are below £2,000 for casualty and £5,000 for motor, you're not going to get your legal costs back. So maybe lawyers won't do it, and maybe people will do claims more frequently themselves. But it's not easy to do it as a consumer, probably impossible on the current version of the portal. So we'll probably need a new version of the portal that's consumer-friendly and that people can use themselves. And I think that's a challenge in terms of infrastructure, it's a challenge in terms of getting it right, and it's a challenge to make that process transparent for anybody that uses it on their own and is not taking advice. So just really to summarise then, as I said, this is a fairly short session on these reforms. There are really just a couple of points to take away. That this is aimed at saving motorists some money on their insurance premiums. 35 quid is the estimate at the moment. It had been as high as sort of 50, 70 in previous incarnations of these reforms. But that's where we are, and it's a very tabloid-friendly piece of legislation. They're all over it. Every time there's a mention of it, there's a picture. Look at this next time. There's a picture of an attractive woman in a red car holding her neck. Seems to be the stock photo that Daily Mail uses and the Law Society Gazette uses on this one. And probably when the bill comes in, they'll pick it up again from their photo library. But there are some risks in this. Obviously, you're going to save on legal costs if people are doing the claims themselves, and you're going to save on indemnity if the levels of damages go down to the tariff levels in the motor space that I was talking about. But there are risks of dealing with litigants in person, for sure. They have no reasonable expectation of what the process feels like, what they're going to get from it, how frequently they should or shouldn't communicate with you, and how long it might take you to assess their case or what you might do in terms of helping them through the process. And that's kind of an uncharted area, and I think it's a relationship that is fraught with risk and danger. If a consumer who's not an expert in this process is coming directly to insurers, whether in motor or in casualty, saying, can you help me please, I've been injured and I think it's your insurer's fault, and they haven't got someone being seen to defend them, then the prospect of people saying there's a bit of abuse going on here, there's been an under-settlement, is a reasonably strong one. And I think that needs to be looked at. So some ways to reach out to litigants in person as these reforms come through, to protect your reputation, and also to make these cases be capable of resolution. Because you don't want all of these claims being ones that somebody gets 2,500 quid, they think they should have got 20,000 quid, and they write to your chief executive each and every time you have one of these cases. That's just not going to be in anybody's interest, and it's going to give you a hell of a headache as well. So implementation, probably around about the same time as I talked about before, and subject to all those uncertainties as well. Needs primary legislation for the Whiplash stuff. The small claims stuff will come in at the same time. So perhaps end of next year, October next year, perhaps into early 2019. We haven't seen the bill yet, the actual detail of the bill, but it has been mentioned in the Queen's speech, so there'll be parliamentary time made for it. And we know that the provisions of the Prison and Courts Bill on defining whiplash injury, on defining that ban and defining some of the other processes will be replicated. So quite a lot of the work's been done, so it could move quite quickly. But again, it's subject to that overriding uncertainty, just given the political environment that we're in at the moment. And that's it on that one.
Thank you, Alistair. I'm quickly going to deal with some the work that we've been doing on fraud and insurance fraud, and there'll be plenty of time for questions, so do please feel free to pipe up. But the Insurance Fraud Task Force, we did a lot of work. I mean, I think, as all you guys know, we did a lot of work on the Insurance Act. David Herzl was the Law Commissioner 2006 to 2012 who made those reforms. He was, and still is, BLM consultant and helped us and you with that implementation. And he was also asked if he would. He also asked if he would. There's an accident waiting to happen, wasn't it? He was also asked if he would chair a fraud task force looking at the issues around insurance, and he did so through 2015, and quietly kept us informed of what was going on. It reported in January 2016 with 26 recommendations, and the final one of which was that there should be sort of an ongoing review. The government is a bit cash-strapped. The civil service seems to be, what's the politest way of stretched, is the best way of putting it. And David mentioned that he thought that, so that final recommendation about keeping an eye on the other 25 recommendations was perhaps under threat. So we've quietly been hosting meetings throughout 2016 and 2017, bringing together all of the key players. So there's a lot of work has been imposed on the insurance industry to bring together some of these issues. So we're regularly in touch with ABI, the IFB, and regularly in touch with SRA, the Information Commissioner's Office, and we do still have the help of the Treasury, the Ministry of Justice, and various other organisations. They produced some, and it is very encouraging to see how people are still working together, because fraud just doesn't go away. Now, we spoke about the measures that had been adopted to bear down on fraud in the motor sector. You will have seen this weekend the two people who were imprisoned for holiday sickness fraud, private prosecution brought by Thomas Cook, who in fact instructed a colleague of mine, Sarah Hill, up in Birmingham. And they are now doing time. And that is the attraction of holiday sickness fraud for the claims management companies who are actively pursuing it, is that it is not subject to a fixed recoverable costs regime. Costs are at large, it's the usual sort of hourly rate, time and so on and so forth, and so the costs incentive in pursuing those claims are significantly larger than going through those other regimes, which is why I wanted to highlight fixed recoverable costs coming in across the whole civil liability sector. So we, as I say, so we've been keeping an eye on that, and what happens is that with holiday sickness claims, sort of yes, at the moment it's the tour operators who are bearing the brunt of it, but we know that claims are now being presented, recovery actions by the holiday tour operators against the people who they're contracting with, and those are feeding through into liability claims, which are coming back into the market. So it affects everybody, and all I wanted to try to do is to make you aware of the work that we have been doing, that the Insurance Fraud Task Force is continuing and will continue through next year. We've got quite a large meeting of all of the acronyms dealing with insurance fraud on the 15th of November over in Plantation Place. A report on the 2017 activity will be produced, and I'm anticipating that the work will continue through 2018. So there is work going on, and you should be aware of it and should pay attention to it, because you never know when fraud might be heading your way. And that's all I've got to just, that's perhaps a slight plug on BLM and Insurance Fraud Task Force, but it is important, and I just wanted you to be aware of that activity. And now happy to take any questions on almost anything. We could have covered issues around Vinook. We could have covered issues around Briggs, which is another series of court reforms and sort of an online and digital court where the government is spending, well, 600 million is the figure I've heard, but I went to an event last Friday where Sir Ernest Ryder is another senior judge, member of the Court of Appeal. He has responsibility for an area of civil liability and dispute resolution that I just do not see. He's quoting £1 billion to be spent and all to be implemented by 2022 on court reform and process, and it's all very interesting and is happening. Does anyone have any questions? Discount rate, where, when?
I just think on the discount rate, is there anything that you can think of that insurers can realistically do to delay settlement when they are aware that a change is highly likely to occur outside of something like, say, con-neg arguments? Is there anything that you can think, or perhaps is there an appetite within the judiciary not to make awards at the negative rate because they know a change is coming?
I think that's a really difficult question. Our analysis was really anything that's scheduled for a trial date sort of between now and maybe summer next year. If that goes to trial, the judge is going to have no option but to apply a minus 0.75 rate. That's the law, and he or she wouldn't want to get appealed. If you can get cases into when the new world is, and we don't know when that is, then yeah, there'll be a different rate, probably 0 to 1%. But as I said in the presentation, it's really uncertain that that's going to happen. And we don't know where it's going to land in 0 to 1%. And there might be things you can do to lengthen the life cycle a little bit. It may be that you need to re-examine care needs, re-examine accommodation adaptations, those sorts of things. And particularly, I think, on infant cases, if the injury hasn't stabilised and the child hasn't reached majority, then those will probably creep a lot further. So, overtly, I don't think there's really any prospect of, let's be frank, cynical attempts to delay settlement. I think you'll get in huge trouble if that comes out. But if there are legitimate reasons to question some of the evidence and some of the regimes and some of the schedules, then that's entirely appropriate to do that. And if a byproduct of that is that it takes the case resolution window beyond when the rate changes, then so be it.
And I think it's also worth having a think about that timing window, because when the bill passes, the rate will not change. It is for the Lord Chancellor to then consider. He has to ask he or she, I should say, should ask the government actuary to produce a report, because the first rate change is going to be based upon evidence from the government actuary and Treasury, I think, isn't it?
That's right.
Yeah, two statutory consultees. And the time limits that are in the bill is 90 days and 180 days. So it's even if they pass the bill in April, sort of it's going to be July at the very earliest, and I can't see it passing by April. So it is Q4 next year at the earliest before there's going to be a rate change. And if you've got cases in that trial window around about that period, well, yes, 0 to 1% is going to be the settlement range, but there's still that uncertainty for the time being.
Well, I'd like you to join me in saying thank you to Alistair and Terry for a very interesting talk.